Sarat, you've been around for a while, but the market's movements today are kind of something to sit up and catch your attention. What are you thinking as you look through all of these crazy moves and everything from the equities markets to treasuries to the dollar and beyond? What catches your attention the most, and how are you thinking about it all?
So, Becky, I mean, this is happening really fast, even though we've been talking about it being a slow order. Every week we're getting 3 to 5% down. Path of least resistance is S&P coming down until we really get in front of earnings season. And we've already seen estimates come down. You've seen GE talk it down, FedEx, companies are coming down, Ford. So I think what we're going to see is a basing around 3,500 on the S&P. That's kind of where we're looking to start really nibbling again. At these levels, there are certain stocks, Mohammed was right, that you can't start nibbling. But I think right now with bonds going up, you're looking at monetary policies, you're looking at countries defending currencies. It's really hard to get in front of it, but as a long-term investor, I would not panic at this point. Look, this is what happens when you have equity risk premium. You're going to get the ups and downs. None of us could call it. And if you do have cash on the side, you start nibbling, but I do think it's going to get, we're going to get some good values down here because there are some really good companies with strong balance sheets. We went through that. And as long as we don't, destroy demand completely, I think we're going to come out of this in good shape. But you just have to have patience. That's really hard at this point when people have seen a lot of value being destroyed.
You said 3,500 is where you'd start nibbling on the S&P 500. That is about 200 points from where the futures would indicate the S&P opening this morning. In the meantime, you just sit tight?
Well, I think you look at specific stocks, and some of them could fall harder, but I would not sell at these levels. I think you have to actually wait till the earnings season comes through. And one of the things that a few of your guests have talked about, I think we really have to focus on where we can get more supply out there, because that's where we're seeing higher prices when it comes to food, it comes to energy, it comes to infrastructure, housing. And I think that's kind of where we need, global intervention, or even if we can work on it in the United States, that will offset some of the demand destruction, and that will make the Fed's job easier. That's kind of where we don't have clarity on.
Oh, sorry, go ahead, Sarat.
Well, just in terms of, food supply, things like that, where we just need to bring down the prices of a lot of the goods that people just need of basic staples. And I think that's adding to this inflationary pressure that is causing the Fed and global governments to kind of raise rates.
When you start talking about bringing down prices, you look at the energy costs in the UK, and what they're doing to try and cap prices is pretty inflationary too. They're going to have to sell more debt in order to finance the difference between the caps that they're putting on and the reality of what they'll have to pay to secure those things. How do you do it in a non-inflationary way that doesn't make the problem worse?
Yeah, that's right. I mean, in terms of non-inflationary ways, you just have to start, supplying more. You have to start drilling more, or start going to, coal and nuclear for the longer term. And I think that puts some pressure on the prices. But manipulating with, putting caps in, that's just more inflationary. Those inflationary things are just going to cause more confusion in the market. And it's not really going to be a long-term solution, but in the short term. But you are seeing oil prices come down, and it'll be interesting to see what the winter looks like in Europe. And that's a wild card. So right now, the negativity is overriding everything, and people are not giving markets the benefit as to, hey, it's going to be a warmer winter. And I think when you put all those together, it's a potent, cocktail for earnings coming down and a global slowdown while inflation is rising.